Back for the second episode here of the Mitten Mortgage Lending Podcast. Still working on a name. I'm Matt Horvath. That's Chris Sabonik. First thing we're going to talk about, normally we go through a program to highlight on each month, but today, kind of in general, we're just going to be talking about refinances.
Yeah, so not going to, like Max said, not going to really narrow it down to one specific loan program this week or one product. We're going to be talking about, in general, just loan types. So we're going to talk about refis. There's a lot of different types of refis. We've got three, I think, I guess there's two main types of refis. We're going to run through those with you. There's some subcategories to those as well. But the first thing I know we wanted to talk about that Mac was going to share with you was the rate and term refinance.
Yeah, so a regular rate and term, again, that means exactly what it says. We're either going to be adjusting your interest rate, taking that, obviously trying to take it lower, or the terms, taking you from a 25-year or 20-year to a 30-year, or if you started a 30-year, back up to a 30-year. So that means exactly what it says right there. So conventional, I know that I entered one this past week that actually we got a 4-day clear to close on it, and we're taking a client that just bought last fall from a 7.625 down to a 6.625. So dropping that interest rate a full percentage point, making them happy, kind of accomplishing their goals with it. And then on the FHA side, same thing. Right now we're doing a rate and term refinance for a client, taking them from a 7.25 down to actually a 5.75 with the FHA. So two great benefits for some of our clients for the rate and term, which again, you should be keeping an eye out or paying attention to. If you have that interest rate that's basically above 7.25, whether it's conventional or FHA, might want to be reaching out because there could be an opportunity for you to take advantage of that.
Yeah, and it might not be time right now, but if you give us a call and we get ahead of it and just do a little checking into it, we can kind of line you up so that you're ready to go when it is.
Yeah, we think they're going to get a little bit better as far as interest rates go. So it's nothing people need to jump on board with right away. Not necessarily everyone at least. But yeah, we expect it to get even better as the year moves on.
Yeah, and depending on when you bought, I mean, there are some people who bought Q2, especially really Q3,
Summer.
Q4 of last year, kind of, end of the summer last year, maybe going into the fall. Again, depending on how much they put down, what their credit score was, there's so much more that goes into it. But really, people that bought kind of in the latter half of last year, if it's not time for them to refinance, it will be
getting close.
It will be very soon, and it's getting close.
Yeah, it's getting close.
If you're curious, if you're not sure, give us a call. We'll definitely steer you in the right direction.
Yeah.
So the second part, Matt covered the rate and terms already, but another big type of refi, and one that we really should talk about, is a cash out refinance. So right now, in the United States, equity is up higher than it's ever been before. So homeowners in the U.S. have more equity than they've ever had before. They have right now. There's $32 trillion in home equity in the U.S. Boatload of money. But what's also way up is credit card debt. There's $1.13 trillion of credit card debt in the United States right now.
Yeah, both are as high as they've ever been.
Yes, both are up. So equity is up. There's more equity than there's ever been. There's also more credit card debt than there's ever been. So both are extremely inflated. Now, we're talking about rates. We were just talking about how they're going to be coming down, which they should be. Rates are still perceived as high right now. Everyone thinks that rates are still high. So on a mortgage interest rate, we'll get into this a little bit later with the rate updates, but we're essentially hovering right at or around maybe just below 7% in that ballpark neighborhood, depending on your qualifications. So sure, home interest 7% sounds high. I guess people think it's high. The average credit card interest rate is between 25 and 30%.
Yeah.
So 7% is great
compared to those.
Compared to 25 or 30%.
Right.
And there's so much more that we're going to talk about with the cash out, but with your credit card being up, if you're paying 25, 30% interest on your credit cards and it's going nowhere, you're making that minimum payment every single month and you're not watching it disappear, you're not even watching that balance go down. In fact, I know in a lot of cases it's actually just continuing to go up if you're only making that minimum payment. To trade that out for a 7% or something in the ballpark to start narrowing that down and start knocking it down is massive, and definitely something that people should consider, especially if they have equity in their home. There's no reason to be carrying a ton of credit card debt if you have equity in your home.
Yeah, and it's pretty simple for clients to look at, and then obviously we can help navigate you through it. But if your current mortgage payment is $1,500, but you have a couple credit cards, maybe some are maxed out. If you're paying $1,000 in credit card payments every month, Well, you're paying $2,500 total between your mortgage and those credit cards. If we can get you a cash out refinance where maybe you're only paying $2,100 a month, you're saving $400 a month, which obviously is a huge benefit and a huge savings for a lot of people trying to, maybe you went through hard times with COVID, those things ran up, you just didn't keep an eye on your finances, got a little loose with it, and now it's time to tighten that back up. And striking that a cash out refinance is something that can allow you to achieve those financial goals quickly.
Yeah, and this just popped in my mind while we were talking here. Credit card debt is definitely up. So credit card debt is high, but what's also crazy right now as far as interest rates go is car payments. Car interest rates are insane right now. I know there's a lot of car rates at 9, 10, even north of 10%.
Right.
So, we're not just looking at credit card debt here. Really, any debt that you have right now, if you have equity in your home, we can most likely improve upon your financial situation, at least by looking into
and there's things we've talked about before where when rates were really low, we had a lot of people getting into 20 years to 15 years refinances where you're able to reap the benefits of those for the past 4 or 5 years and really build your equity. But if you love your home and things have gotten tight as far as finances go, that could be an option again to look at to improve your financial situation, and also maybe, like we talked about, improve your credit score, because these high credit card balances are something that could be having a major effect on your credit score. So again, if it's something that you may want to move in the next month or in the next year or two, and we want to try to improve that credit right away, taking the cash out refinance, taking care of a lot of that debt should help clean up your credit score. And then when that time comes and you're ready to move, a year or so from now, the credit score is where you want it to be and where you can go start making competitive offers.
No, that's a great point and a super important point that Mac made, and it's kind of like auxiliary to doing the cash out, but it's an added benefit. If you're consolidating debt and you're doing these things, a large chunk of your credit score is based on credit utilization. So if you have really high balances on your credit cards compared to what your credit limit is, it's likely dragging down your credit score and bringing down your credit score a little bit. So if we do some sort of equity, loan for you, whether it's through a home equity line of credit, a home equity loan, we do a regular cash out refinance. If we do that, pay off your credit card debt and get those revolving balances back down, you should almost instantly see an improvement in your credit score. What's a better credit score do? The next time you go to refinance, or like Max said, maybe you're thinking about making a move, but you want to consolidate some of this stuff before then, you pay down some debt. A higher credit score is going to get you a better interest rate. It's going to get you qualified for more loan types. It's really going to just kind of open up your options whenever that time does come and you are ready to move. Just based on getting rid of some of that credit card debt, you should be in a much better situation for your next loan.
Yeah, it's going to make you a stronger buyer. Like at the end of the day, simple said, like it's going to make you a stronger buyer.
You'll be able to afford more home. There's the list goes on and on, really.
Yeah, there's tons of benefits to it. Again, if it's something that you're able to take advantage of, and a lot of people I think it's a hassle, or maybe it was a hassle to get that original loan. We can close these again quickly. Speed is one of our top priorities over here. The efficiencies that we're able to do some. You can still get appraisal waivers even when you're doing a cash out refinance. So those are still a possibility. So yeah, it's definitely something that we would be happy to have a conversation with you if that's something that you think might be able to clean up your finances and help you out.
Yeah, and I think one more important thing to note, just when we're talking about doing cash outs here or doing any type of refinance, we just talked, we kind of started things out and we were talking about how rates are coming down. Now, we don't know exactly when it's going to be, we don't know how long it's going to be, but rates are trending down, as time goes on here, and should be trending down. One big piece of that is pretty much no matter what loan you get right now, whether you refinance, whether you go buy a new house right now, whatever you're doing right now, it is probably not going to be your loan in a year, maybe a year
to
and a half.
18 months.
Yeah, I guess it depends on how long this rate adjustment takes and how long it takes for things to start sliding down. A lot of unknown variables, but no matter what the case is, no matter what you're doing right now, you probably won't have that same mortgage in a couple years. So the big piece of this is the loan level pricing adjustments from Fannie Mae and Freddie Mac. Anytime you're getting a loan that's not, I guess any layer that you add to a mortgage that makes it riskier is going to adjust your pricing on the mortgage. So if you are doing a cash out refi, Fannie Mae and Freddie Mac have what's called loan level pricing adjustments. Loan level pricing adjustments are on every single loan. And anything that's not standard gets a loan level pricing adjustment. So if you're doing a cash out refinance instead of a rate and term refinance, you're paying a little bit more for that. If you're buying a condo or refinancing a condo as compared to a single family home, you're paying a little bit more for that. If you're putting 5% down instead of 20% down, or 20% down instead of 40% down, the list goes on.
Higher risk.
You're
It's
going to
just
be paying a little bit more. It's all risk.
yeah. Anything with a loan, higher risk is going to equal higher interest rate.
Yeah, and to give an example of that, like a real world example, if you compared a cash out refinance today to a rate and term refinance today, or really anytime, even when rates come down, when rates adjust, generally speaking, you're probably looking at about 3/4 to a full percent difference in your interest rate. So if someone's doing a rate and term at 6.99 today, they're most likely getting a cash out at 7.75, maybe 7.99. So there's a big difference there. I guess full story here. The reason we're even talking about it is, if you're going to look at consolidating your debt right now and you're going to do something with it, now's a great time, because let's pay the cash out adjustment right now. Let's pay the extra LLPA right now.
Let's get that loan that comes with the bad interest rate, because we're not going to be in it very long.
Right, because rates are perceived bad right now anyways. So let's get the loan with the bad rate and then have a game plan that we know exactly what we're going to do. And as soon as rates get to here, we're going to go ahead, we're going to refi, and then now you're going to get that rate and term. You're not paying those extra LLPAs but if you wait for rates to come down, you'll get a cash out refinance when rates come down. You won't be taking advantage of, the lowest rates you can possibly get, essentially.
Right. So you want to really consolidate that debt ahead of time, and that's what we're saying now is a good time, because once you get that taken care of, the rates aren't ideal or that an ideal spot. Everyone's out there thinking that is either bought recently or done some sort of cash out refinance, that when rates drop, I'm going to refinance to that kind of interest rate I want to have for an extended period of time. Yeah. No one's looking, they might be looking for their forever home, but they're not looking for their forever interest rate right now. That's for sure. Yeah. So if we can take advantage of that cash out now, get all of our debt under one umbrella, yeah, it's going to have a higher interest rate now, but let's do that so that way down the line, 6, 8, 9 months, 18 months down the line, when rates do drop, we get to take that cash out, that rate and term refinance and get that interest rate, which is now more in the vicinity of what we're going to want.
Yep, 100%. Yeah, now, I mean, if you're even thinking about it, or you think you might be in a candidate for this, you think it might make sense for you, give us a call, shoot us an email. We'll run the numbers, and if it's not worth it or it doesn't make sense, we're going to highly suggest that you don't do it. Yeah. And we'll set up a game plan for when it will make sense.
And then kind of which we also can handle here as well, kind of the cousin of the cash out refinance is the Helocs. Which again, there's benefits to doing the cash out as opposed to the HELOC, but that's also an option for people as well.
Yeah, Helocs and Heloans, both a great option, both a second mortgage, so it would involve not touching your primary mortgage that you have right now. Really case by case dependent for people. As far as Helocs go, we can do Helocs down to 660 credit, and we can go up to 90% LTV. So you can get a little bit more equity out of a HELOC than you can with, say, a regular cash out refi. Both of them are great. HELOC is exactly what it says. It's a home equity line of credit, so it's a line of credit that you can pay down and borrow against as needed. It's right for some people. It's not right for other people. We also have Heloans, which are fixed over a certain term, and those are just paid down either over a 20 or a 30-year term. So it's not like a line of credit. You can't go back. You can't borrow from it, but you can get a chunk of money if needed for something, and then pay it back over time. With so many different options out there, it's tough to say what's going to make sense for someone, but if we call you, we have your app, we have your financial info, we're going to be able to see exactly what makes sense.
Yeah, so again, talking about the equity that's out there, the debts that's out there across America, again, they're both at their highest that they've ever been, so we thought this was a good time, especially with rates starting to trend where they would trend, to give you guys some information on refinances. So we're going to take a short little break, and we're going to be back, like we said, each month with a segment, kind of loan of the month, and we got one of our bankers joining us, Doug Weir, to share that story here in a little bit. All right, so we're back with our executive loan officer, Doug Weir. Chris, how long's been Doug been with us?
Doug's been with us for about 3.5 years now.
He was there for the inception of Mitten Mortgage, like we just chatted about.
Yes.
But yeah, Doug's been with us for a while.
Doug's been with us for a long time. I know Doug's been in mortgages since 2012, so he has a ton of experience in a lot of different roles within mortgages, both banking and helping out with stuff on the back end too. So no stranger to Mitten mortgage lending. Like I said, been here for 3.5 years, and definitely no stranger to mortgages. Been doing that for almost 12 years now. So yeah, we're definitely happy Doug's part of the team.
Yeah, Doug's going to tell us about our loan of the month that he had a great experience with. So yeah, tell us about it, Doug.
Yeah, so happy to be here. It was utilizing the Home Possible loan. It was a great product. A lot of our real estate agents, in particular the one I was working with on this loan, wasn't aware of it. It is some income-based type loans that Fannie Mae has guidelines for, but a lot of folks are going to qualify for it and not even realize it. But it helped out with this client that we were able to get a clear to close inside 2 weeks. We were able to utilize a low interest rate without having the best credit score available, as well as getting an appraisal waiver, which really kind of pulled the deal together for everybody involved. The realtor that was representing our client was kind of blown away by it. We eventually closed on another loan together utilizing the same product, and he didn't even know that this existed. So it was an awesome experience for everybody.
And Home Possible, conventional loan that a number of our bankers have used. But yeah, like you said, a lot of people don't know kind of what's available to them out there. And again, like we've talked about before, working with a broker is, the difference there to offer the variety of products.
Yeah, and well, I was gonna say to jump in really quick too. Part of the benefits of Home Possible, the LLPAs that I mentioned when we were just talking about refinances, or really any loan, those LLPAs are in every loan. They are capped on a Home Possible loan. So even if you start racking up all these adjustments, your credit, your down payment, you start hitting all these LLPAs. That Home Possible program caps those LLPAs. So that's kind of what Doug was saying. We were able to utilize a lower interest rate and a better interest rate than what this client should have perceived received because Home Possible capped all those adjustments. So even though the client's credit, I believe in this circumstance, her credit was actually under 640.
Correct.
She because those adjustments were capped, she basically received an interest rate that was similar to somebody that probably had a 720 or 740 credit score.
Absolutely. And a lot of folks in that credit realm are thinking they're going to have to go FHA to avoid some of those costs up front, which isn't the most attractive offer to a listing agent. So when they can get a conventional loan, that really helps them out on their side of getting their offer accepted and helps the listing agent go back to their client with a lot of confidence.
And with this, you're also able to get an appraisal waiver, which
We did.
That definitely helps the deal as well, with
It
only
does.
putting 22% down.
Yep. And with the technology we have, we knew that up front. So we were able to let the listing agent know that as long as everything remained true in underwriting, that we had the waiver up front, which also helped them stand out.
So you submitted her offer not contingent on an appraisal
Correct.
because she didn't need one.
Right. Yep.
Yeah, always a positive and always a big plus. But that's only kind of half the story with why this loan was so special.
Yeah, our client had some really tough times in the preceding 8 months or so, losing some family members, one not too long before our closing. So having a team behind her that she was able to trust and know that she could communicate with one or two individuals only rather than hearing from 6 or 7 different people, as can happen in underwriting sometimes when you're not working with your broker. She really felt comfortable about that, and it made this a lot easier for her and the grandchildren that she was going to help raise there.
Yeah, so that's a really cool story. She was able to take the grandkids. How many bedrooms do we have to get for this place?
So I think they figured out with 3 was okay, but it had a pool in the backyard, so most of their time was going to be spent there. So they'd
that
be
was the
worn
big
out.
factor.
So that was the big factor in it. She loved that, and it was really really fun day at the closing to be able to see how happy she was that this was able to come to fruition, and she could already see the memories being created with the grandkids.
Yeah, like we talk about, our job's cool, but when you get to do stuff like that, it's even better.
That's what makes it worth it.
It's always fun when someone gets the keys to their house, but sometimes it's a little bit
More special.
Yeah.
Yeah. All right, so then we got the market update that we would like to hit on. I know, Chris, we ran some numbers earlier on that.
Yeah, so I ran some numbers here just before we got started. Again, we'll kind of give you this every time. We're going to be pretty generic with it. Please call us, please email us, get a hold of us, because everybody's interest rate is going to be so dependent on so many different factors that are going into it right now. First time buyer, credit score, down payment, all those things. Want to kind of give you guys a pretty generic example that we're just going to use over and over again. So $250,000 purchase price, 5% down, someone with 780 credit. right now, for no points, not paying anything extra for it, not coming out of pocket to pay points or anything like that, that rate's hovering right in the 6.99 range. So we are under 7%, at least right now. Obviously, this stuff bounces around every day, but a little lower than the last time we talked. I think we were very low 7% when we did this last time. So not coming down very fast, but
We're under 7 this time.
We're under 7 this time, and I think we're headed in the right direction. So
Yeah.
And utilizing right now the 1.0 buy down, I think, is a great opportunity because we know the market is going to come down. So in the meantime, have your seller pay for your rate to be 1% lower in that window in which you're going to be looking at refinancing anyways. So take advantage of what the market could be for the first year on them. And in the meantime, end of April, we've got our credit still running where they can have the appraisal credit. So I mean, it's a great time to take advantage of that.
yeah, so like Doug said, 1.0 buy down, especially with rates where they're at, bringing that interest rate down a full percent.
Huge.
Why wouldn't you if you could? And then, like he said too, we talked about it in the Mitten Minute last week, but we are doing that appraisal credit through the end of April for anybody who's got a 1.0 buy down.
And that could be something too that honestly saves the deal. I've had it happen with a number of my clients where there's been some concession negotiations going on. They got a little tough. I can tell, or I know one of real recently that happened where a client was locked in to purchase a home. We had them locked in at a 6.625, and that deal fell through. After their inspection, there were some major foundation issues. They had to walk away. They didn't find their next home that they got an offer accepted on for a couple weeks later. And by the time that it rolled around, they were up to a 6.99. Those interest rates had went up. So the buyer was a little upset with that, that they missed out on that opportunity. And then come to find out the offer they got accepted on, there was, again, some smaller items to take care of with the inspection. They were able to do some negotiating, but they were kind of far apart with what they wanted. Our buyers wanted like 8-9 grand. The sellers want to give them like $500. So there was a big gap there. We were able to meet them in the middle. And part of it was I explained to them like, hey, if we get a certain number, if we're just over this threshold, you can do a 1.0 buy down. And then for the first year, we're at that 5.99. I know you were upset to go from 6.625 to 6.99, but for the first year, we'll get in the 5.99. We're going to take care. That's going to get the free appraisal like he was able to take advantage of. And then obviously, like we mentioned earlier, when rates dip, hopefully we get something more permanently in that 5.99 range or something below 6. So
Yeah.
definitely something to look to take advantage of. Again, it can be something that saves the deal.
Yeah, no, that's a pretty awesome story. Buying a house is a pretty emotional thing. So when you go from the emotions of going through it, you like a house, and then something happens in the inspection. You like the house, you start envisioning living there. Then you go to the inspection and it doesn't go well. Then you're bummed out because of that. Then Matt calls and tell you, hey, just guess what? Rates actually went up between the last house you found and this one now. Your rate's going higher. So for you to be able to to get the 1.0 buy down in there and work that in and get that in the deal and kind of almost make everybody happy. I think that's pretty awesome, especially with all the emotions that, like I said, go into the home buying process.
The concessions part's great. When I hear that a client of ours is getting concessions, my mind starts racing like, all right, how can we use this now to put you, it opens up all kinds of options right now.
So many different options right now, especially if there's concessions or any type of credit on the table for sure.
Yeah.
Cool. So I guess the next thing that we'll chat about is we have an event. We're sponsoring an event here in downtown Wyandotte. It's a photo scavenger hunt. It's going to start at Bishop Park on March 30th. It's from 12 to 3. Ton of other local businesses are involved here in downtown Wyandotte. Like I said, it's a photo scavenger hunt, so you'll be doing a little bit of running around downtown Wyandotte. There's all sorts of prizes. I know there's a 65-inch smart TV. I know there's a ton of gift cards to local businesses, local restaurants, things like that. So again, that's March 30th from 12 to 3. Right here in downtown Wyandotte, and it'll start at Bishop Park. We'll have some more info about that, but if anyone has questions or anything else, please reach out to us, and I'm sure we'll put some info.
Yeah, pay attention to social media. There'll be a lot of info coming out, especially in the couple days and week leading up to that. Again, that's a Saturday, March 30th from 12 to 3, starting out here at Bishop Park, just behind the office back here. So definitely check it out. Hopefully the weather is nice, as we've been getting some good weather, so hopefully it lasts. And if you're not on the golf course, you should make it down here for that photo scavenger hunt.
Yeah, definitely. I think that's it. Anything else?
No. Thanks everyone for tuning in. We appreciate all the support we got for episode 1, and hopefully episode 2 you guys found just as helpful, and look forward to more out there on social media coming up soon.